Hello everyone. Today I'm going to talk about the Washington DC metro area commercial real estate market. My name is Denise Sanyurt. I work as a commercial real estate investment advisor. Commercial real estate is reimagined after COVID-19. Let's go over the details. Since the beginning of the coronavirus pandemic, I have been following the analysis presented by various media resources, namely U.S. Department of Labor, National Association of Home Builders, IMF, Moody's Analytics, REIS, CoStar, CCIM, ICSC, and many other resources like podcasts. I am especially grateful for the detailed data provided by CoStar. After participating all those webinars and presentations, I decided to share my takeaways with my clients with the hope that this will help them to make better commercial real estate investment decisions. Let's talk about the impact of COVID-19 on the US economy. Since the beginning of the pandemic, unemployment claims hit a record high of 25 million people. Before the crisis, U.S. unemployment rate was 4.4%. It has now reached to 18%. In Maryland, D.C., Virginia, total unemployment claims have already passed 2019 figures. After stay-at-home orders, total retail sales fell by 8.7%. Industrial production has also dropped by 5.4% in March. Oxford Economics said the U.S. economy shrank by 9% compared to the first quarter of last year. IMF foresees to have 6.6% decline in U.S. economic growth. U.S. government swiftly introduced CARES Act to support small businesses with $2.2 trillion budget. However, the deliveries of those funds are being delayed, and those limited resources have already reached their limits. Furthermore, the House passed a nearly $500 billion interim coronavirus bill last Thursday. That includes additional money for the Small Business Loan Program as well as for hospitals and testing. Deriving lessons from past crises, U.S. government taking necessary steps to support businesses suffering from COVID-19 pandemic. Here is the chart that shows more detailed information about local employment. DC, Fairfax, Prince George County, and Montgomery County are the top runners with regards to unemployment claims. As expected, educational services and leisure and hospitality sectors have experienced top job losses. Now, let's talk about the impact of COVID-19 on the commercial real estate property types. In commercial real estate, we classify property types into four categories: retail, office, multifamily, and industrial. Retail. Let's talk about retail first. Among the major property types, Washington, D.C.'s retail sector is particularly exposed to the impact of coronavirus. As of now, businesses in all three states deemed essential are the only ones allowed open at this time. Spending at bars and restaurants went down nearly 27%. By contrast, spending at grocery stores jumped by more than 25%. Washington, D.C. metro area has 4.5% vacancy rate, which is lower than U.S. average. Even with the pandemic, it is expected to stay lower than the U.S. average retail vacancy rates. Yellow line here shows the U.S. retail vacancy rates, and green line here shows the Washington, D.C. retail vacancy rates. Washingtonians want three things from retail spaces. First, food and eating places. Second, grocery stores. And the third, health and fitness clubs. Except the grocery stores, food and eating places, bars, health clubs, health fitness clubs hit really badly with pandemic. New guidelines regarding the regarding the new guidelines uh, new guidelines regarding the required distance between clients will have a very big negative impact on restaurant seating area sizes. Especially small-sized eating places will have to create new ways of catering their clients. As meeting the size requirement will be very costly for those small businesses. The other concern are the job losses and increase in the number of people working from home, both of which will have negative impact on demand for restaurant services. That said, we can expect that the landlords will shy away from once sought after tenants, such as restaurants, hair salons, nail salons. Businesses considered essential during the pandemic will take the priority in leasing activities. Due to stay-at-home orders, landlords and tenants are debating over rent payments. If this virus is not contained and social distancing practice does not stop, we can expect bankruptcies. This will lead to higher vacancies, especially the shopping centers that are leveraged at higher levels might suffer from this situation deeply. If that happens, we might see those shopping centers to change hands at lower prices. The other factor that's used to help to boost the Washington, D.C. retail real estate market prices was the funds from the foreign investors. However, we have already seen decline in foreign investment last year. Due to travel restrictions, foreign investment numbers are expected to further decline. That will also have negative impact on the prices of those retail centers. Um, in summary, grocery stores will stay important. They might lease, in fact, more space due to increase in e-commerce. Those grocery stores will need more space to store the orders locally, so they might take up those recently became available vacant places in those retail spaces, and they might lease those areas. Restaurants might suffer because of the 6 feet apart requirement that will make it very expensive, especially on the small mom's pop shop restaurants. Catering will increase. Small space need will increase. Job losses, working from home will shrink the restaurant service demands. We can expect to see shorter lease terms. Dispute over rent payments, bankruptcies might lead to increase in vacancies. The shopping centers highly leveraged might suffer from high vacancies. Will might suffer from it. High vacancies might lead to lower prices and higher cap rates. Office space. Let's discuss the office space market. The office market of Washington, D.C. metro area has already been suffering from higher vacancy before COVID-19. With the coronavirus pandemic, we expect to see the office space vacancy rate go up to 15%, which will take the total negative absorption rate to 5 million square feet. We believe that it will require a few days before office demand to pick up the level before the COVID-19. With its more than 1 million square feet lease space, WeWork seems to be the most exposed tenant in Washington, D.C. metro area, office market metro area. Depending on how the market reacts, co-working space companies might benefit from it or suffer from it. Um, the, While higher level of hygiene standards, and larger space requirements between individuals will increase the cost of maintenance of the office space, the companies downsizing due to COVID-19 might choose to use co-working spaces instead of leasing full-scale offices. With COVID-19 pandemic, we are all pushed into working from our homes virtually. Most of us realize that it is actually working. According to a survey done among CFOs, cutting expenses stands out as the number one priority. From this point on, we believe that aside from health concerns, companies will be inclined to accept requests of employees to work from home in order to reduce the cost of leasing. Office space absorption is directly connected with the employment levels. With the high level of unemployment we are observing now, we can assume that vacancy rates will increase as well. Lesser employee means lesser space to lease. Companies were already reducing their space requirements before COVID-19. COVID-19 accelerated the trend. Given the uncertainty in markets, we expect to see shorter-term lease. Landlords will try to get the tenants in, and they will be willing to accept the terms that was not acceptable to them before. Well, let's summarize. Virtual office is working. We expect to see downsizing. Shared offices might benefit from this depending on how they solve the hygiene requirements. Need for the collaboration and socialization of the people will still push for the office space demand. Unemployment rates are high, job growth is low, lesser employee in the office means lesser space to lease in total. We expect to see vacancies reach to 15%. Office space was already suffering from high vacancies. COVID-19 will accelerate the trend. Higher cap rates, lower prices are expected. B-class and C-class buildings will suffer more. Shorter-term leases expected. Landlords will try to get the tenants in. Given the economic difficulties, tenants trying to get out of their obligations will try to sublease their space out. We expect to see increase in subleases. Demand for office space at remote places, suburbs might increase. Let's talk about the multifamily. Washington was emerging as one of the strongest apartment markets in the country before the coronavirus pandemic. Strong renter households, a healthy job market, and costly home ownership underlined Washington's strong multifamily performance. Washington is also one of the most insulated markets in the country, as its economy isn't as concentrated in high-risk sectors like leisure, hospitality, and energy, and it is supported by the federal government. Those demand drivers are still in place, but with the pandemic, those positive numbers are eroding by each day. According to CoStar, vacancies are rising and rents are decelerating because of the continued supply of multifamily type of properties and weakened demand for multifamily properties. However, even with this forecast, Washington multifamily market looks stronger than the most markets in the country. As you will see from this chart, yellow line indicates the U.S. total vacancy rates. Green line indicates the Washington, D.C. metro area vacancy rates. Washington, D.C. Multifamily market vacancy rates are lower than U.S. average, even though it is expected that the Washington, D.C. multifamily vacancy rates stay lower than the US market. We assume that it will continue to stay lower. In summary, let's summarize the multifamily market. In summary, we expect to see increase in vacancies up to 8 to 11% due to job losses and decreases in foreign students and foreign visitors. Also, increase in unemployment will lead to house sharing. Children might return to their parents' houses. Considerable decrease in deals due to uncertainty in financing and economic conditions are expected. Increase in delinquencies in rent payments, high cap rates, low prices are expected. Luxury market will be hit the most. Financing difficulty. In terms of financing difficulty, underwriters right now having difficult time pricing out the risk factor connected with the multifamily. On the positive side, not much change in rental rates are expected. As long as federal government, health and defense contracts are funded, we might be okay in terms of multifamily property types. Finally, let's talk about the industrial properties. Prior to pandemic, the availability of industrial space in Washington, D.C. metro area witnessed a tightening, especially in Northern Virginia, with much of the investments focused on life science and cloud computing companies. Commercial investors concentrated on acquiring data center and R&D assets, causing 2019 to outpace previous years in sales volume. With vacancies trending below the national rate, DC metro logistics market had been driven by distribution centers, with the bulk of demand coming from retailers and third-party logistics. These companies' main objective is to be near major population centers within the metro and in brick-and-mortar locations. Given the demand shift to online shopping due to COVID-19, demand for distribution centers are expected to increase at larger levels. The other industrial space consumer in metro area are tech companies with the demand for data centers. Data centers in Loudoun County right now host 70% of internet traffic. With people confined at their homes, we expect to see considerable increase in data centers, consequently demand for industrial spaces. With the expected new deliveries in 2020, industrial space rents are not expected to change considerably in general. However, with the expected bankruptcies of small and medium-sized companies, we might expect to see higher vacancies and decrease in market rent for flex spaces. Let's summarize. In terms of industrial property types, we expect to see demand for industrial space to continue. Increase in online shopping will increase the demand for storage, logistics space, and we might use some of the extra space as storage in those retail spaces and repurpose retail spaces for logistics needs. Demand for flex space might drop due to small and medium-sized companies suffer bankruptcies due to COVID-19. Rent will stay stable in terms of industrial property types. Sales prices expected to continue to increase. Well, in summary, we see that acceleration of pre-existing trends will continue. Changes and trends we have seen before the COVID-19 will accelerate with this crisis. Out of all property types, industrial and multifamily seems to be the potential winners. Retail, office, and hospitality seems to be the potential losers. Winner property subtypes will be self-storage, manufactured homes, grocery store, anchored malls. Financing is getting tight. This is as good as it gets in terms of financing. And well, financing is getting tight, and this is as good as it gets in terms of financing. Underwriters right now are having tough time to price the risk because of the volatility in the markets. This is if I tell you one thing, this is the buyer's market. But just don't sit and wait too long because of the difficulties in financing. You might not be able to finance the deal you find, and it will be very difficult to find the opportunities that fits with the requirements of those financing standards. So in order to not to miss the opportunity, I suggest you start working on looking for the property types you are interested, and specify your criteria very carefully so that you don't miss any opportunity in finding those good investment alternatives. Well, as I said at the beginning of my presentation, I wanted to share with you my insights about the Washington, D.C. real estate market during the COVID-19 pandemic. I hope this helps you to make better decisions. If you need further assistance or have any questions about your property or local market you are in, my name is Denise Sanyurt. You may reach me at 571-271-6604, and my email address is denise@mylocationadvisor.com. I work as a commercial real estate investment advisor. If you have any questions about your local market, reach me at my phone 571-271-6604 or email me at denise@mylocationadvisor.com. Thank you.